Generally accepted accounting principles. Accounting principles are the rules based on assumptions, customs, usages, and traditions for recording transactions. Accounting principles may be defined as those rules of action or conduct which are adopted by the accountants universally while recording the transactions. The chief objective behind the accounting principles is that the accounting statement should be both reliable and informative. This objective can be achieved when there's a certain common agreement and compliance about the accounting principles. Generally accepted accounting principles, or GAAP, may be defined as those rules of action or conduct which are derived from experience and practice, and when they prove useful, they are accepted as principles of accounting. Accounting principles are accepted if they possess the following characteristics. Objectivity. Objectivity connotes reliability and trustworthiness. A principle is objective to the extent when the accounting information is not influenced by personal bias or judgment of those who provide it. This implies that accounting information is prepared and reported in a neutral way. In other words, it is not biased towards a particular user group or vested interest. Application. Application of the principle must be possible. In case the principle is only theoretical and has no practical utility or application, then the principle has no value. Reliability. This implies that the accounting information that is presented is truthful, accurate, and complete, nothing significant missed out, and capable of being verified. Example, by a potential investor. Feasibility. A principle is feasible to the extent it can be implemented without much complexity or cost. And understandability. The accounting principle should be simple and easily understandable by all. This implies that the accounting information should be in such a way that it is easily understandable to users, those who are generally assumed to have a reasonable knowledge of business and economic activities. Accounting principles are divided into two categories: accounting concepts and accounting conventions. Accounting concepts. Accounting concepts are necessary assumptions or conditions which form a basis of accounting. The different accounting concepts are discussed under the following heads. Separate entity concept. Separate entity concept already exists legally in a joint stock company. Even in the sole proprietorship and partnership firms, this concept of separate entity, though does not legally exist, is presumed to exist for accounting treatment. Money measurement concept. The money measurement concept increases the true understanding of the state of affairs of the business. For example, if a business has a cash balance of $20,000, plot of land of 5,000 square meters, 2 air conditioners, 1,000 kilograms of raw materials, 20 machines and 50 chairs and tables, and so on, there is an absence of money measurement concept. These different types of assets cannot be added to give useful information. One cannot assess the worth of the firm, but if the same as expressed in terms of money in accounts, like $20,000 cash balance, $20,000 worth of plot, $40,000 of air conditioners, or $2,520,000 of raw materials, $4,600 of machines, and $2,350 of furniture, chairs, and tables, it is possible to add them and use them for any comparison and understanding the financial position of the firm. When the value of the assets is expressed in terms of money, precise information is available with the intelligible financial picture and is more useful for any other purpose. Dual aspect concept. This is the basic concept of accounting. As per this concept, for every debit, there is a corresponding credit. In other words, when a transaction is recorded, debit amount has to be equal to the credit amount. This is also known as double entry principle. No transaction is complete without double aspect. For example, when a new business is started with a capital of $1 million, the position is expressed as under capital or equities is equals to cash, which are the assets. 1 million is equals to 1 million. The term assets denotes the resources owned by the business, while the term equities denotes the various claims of the parties against those assets. The term accounting equation is used to denote the relationship of equities to assets. These are already discussed from the previous modules. Going concern concept. The underlying idea of this concept is that the business would continue for a fairly long period to come. Accounting transactions are recorded from this point of view. On account of this concept, accountant does not take into account the market value of the fixed assets, force value of asset as if business would be liquidated for preparing balance sheet. It is to be noted that the going concern concept does not imply permanent continuation of the enterprise indefinitely. It rather presumes that the enterprise will continue in operation long enough that the cost of the fixed assets would be charged over the usual lives of the assets. Cost concept. Cost concept is closely related to the going concern concept. Cost is the basis for all accounting in respect of fixed assets. If a plot of land is purchased at $1 million, it has to be shown at that amount, even though the subsequent market price becomes $1,500,000. In other words, the subsequent changes in the market price are ignored. Even if the price falls to $80,000, the fall is equally ignored in respect of fixed assets. Cost concept brings the advantage of objectivity in the preparation and presentation of financial statements. In the absence of this concept, accounting records would have depended on the subjective views of the persons. Cost concept is applied to fixed assets only. Current assets are not affected by this concept. Accounting period concept. According to the going concern concept, every business would exist for a longer duration. That longer duration is divided into appropriate segments or periods for studying the results shown by the business for each period. After each period, it is necessary to stop and see back how things have been going. So it is necessary to maintain accounts with references to a specific period. Matching concept. Periodic matching of cost and revenues concept. This concept is also known as matching concept. The main motto of every business is to make maximum profits at the earliest. Efforts and accomplishments are to be matched for proper presentation of operational results. Realization concept. According to this concept, profit is recognized as and when realized. Now, the important issue is what the actual point of sale is and when profit is deemed to have been accrued. Sale is deemed to have taken place when the title to the property or goods passes from the seller to the buyer. Time of transfer of property is material as that point determines the time of recognition of profit. Accounting conventions. Accounting conventions are the customs and traditions which guide us in preparing accounting statements. These are the types of accounting conventions. Conservatism. Concept of conservatism is otherwise known as prudence. Conservative concept, more than any other, has given rise to the idea that accountants are pessimistic and boring people. Consistency. Consistency is a fundamental assumption of accounting. It is presumed, unless otherwise stated, accounting practices are unchanged year after year. If the accounting practices are changed, the fact is to be mentioned and its impact is to be quantified. Once a firm has chosen a particular method of accounting, it should adhere to that method in the future so as to allow for the most meaningful comparisons on a year-by-year basis. Materiality. Materiality refers to the relative importance of an item or event. This convention emphasizes that all material facts should be recorded in accounting. The question what constitutes a material detail is left to the discretion of the accountants. An accountant should make an objective distinction between material and immaterial information. The accountant should regard an item material if he has reason to believe that the knowledge of it would influence the decision. In other words, if the knowledge of information would have bearing on the decision, that information is material and is to be provided. Full disclosure. The convention of disclosure means that all material facts must be disclosed in the financial statements. For example, in any case of sundry debtors, not only the total amounts of sundry debtors should be disclosed, but also the amount of good and secured debtors. The amount of good but unsecured debtors and the amount of doubtful debt should be stated. Full disclosure does not mean disclosure of each and every piece of information. Whether the information is required to be disclosed or not depends on the materiality of information. Materiality depends on the amount involved in relation to the group involved or profits. GAAP organizations: Securities and Exchange Commission, Financial Accounting Standards Board, the Public Company Accounting Oversight Board, American Institute of Certified Public Accountants, and International Accounting Standards Board.